from the bond marketplace. So the best way of all ways to read inflation, some might say it's the 10s 30s curve. It's not even the 10s 30s curve. It's the inflation break-evens, which are treasuries, actually in the treasury market. Does everybody agree with that? Does everybody remember that classroom we did last week when we talked about inflation break-evens as one of the most important lines that we can have on the screens? If we accept that inflation break-evens are the most important line, if the inflation break-evens ever open up above bond prices, what should we be doing with bond prices? What should we be doing with bonds if the inflation break-evens open higher, like the TIPS line? If the TIPS open above bonds, what should we be doing? We should be smashing into the sell side of bonds, yes? So when we look at inflation break-evens in isolation, we should effectively see bond prices, shouldn't we? So when we look at inflation break-evens, we should see bond prices. These should be the same shape as bond prices. And obviously we can see where they gap down, we can see when they gap up. But that's not what's important. It's whether it gaps up against the underlying bond price or not. So when I look at this against the bond price, you can see this morning it's opened gap up. But maybe the bond price has opened gap up even further, in which case the bond will be a buy trade. So obviously when it opens gap up, the question is it gapping up against bonds? If it is, that's telling us of higher inflation. And if it's telling us of higher inflation, we should be smashing into the short side of treasuries. Let's take a look at bonds and see what happened this morning. When we look at bonds this morning, you might say, it's not really opened gap up. I'm sorry, but I beg to differ. I beg to differ. If I look at treasuries, and I look at this price here, and I look at this point here against this point here, the treasury market is obviously opened up a little bit. That's opened up a lot. That's not a small gap up. That's a pretty sizable gap up. In fact, that price of the treasury market, the TIPS markets, let's just do a relative value assessment. The TIPS market at that price there, the last time the TIPS market was at this price was over here. Okay? So that was the last time the TIPS market traded at that point. The bond at that stage was trading where? The bond was trading here. So when we came into the London Open this morning, this is where the bond should have been trading. This is where the bond was trading. And for that reason, we have a massive gap in pricing. That massive gap in pricing needs filled by the inflation break-evens, doesn't it? It absolutely needs filled by the inflation break-evens. And if it needs filled by the inflation break-evens, what are we starting to think? Well, unless that inflation break-evens overtakes the bond price, there is no upside to bonds. There is no buy opportunity. So we need the inflation break-evens to overtake the bond price to the downside, don't we? Short-term or long-term, preferably long-term and short-term, but we want to see that inflation break-evens overtaking bonds on the ride south, and that gives us at least a chance of being able to buy bonds. What's happened this morning? Well, obviously you can see in terms of where we are, the bond price has sold off. The inflation break-evens haven't really managed to overtake, if we look at a relative value basis of where we are on the inflation break-evens and where we are in bonds. We've not really managed to overtake anything. The bond price from the previous level here, so if I take the blue line to the blue line and then I go up into bond prices, the bond prices are down here. So in other words, the inflation break-evens are still behind the bond price, which means there still seems to be inflation being traded by the actual bond desks. And it's not just any bond desk. It's not the retail bond traders. The one thing we told you about the inflation break-evens is retail traders do not touch it with a barge pole because they don't have a clue what it is. The only people that trade in the inflation break-evens market is effectively the direct dealers, the guys that are on the bank bond desk, the real bond traders who trade inflation for a living. These are the guys that trade this market. It's not a gamed market. It's not a market that people are going to buy into and sell into from the retail space. It really is an institutional line. So the downside of this is obviously it takes that interpretation. The best way we can interpret this line is to do it as a ratio. So we do bonds against the inflation break-evens and we ask the question, what is it doing? We can see what it's doing this morning. That gap down, now bearing in mind that that gap down is created because of the fact that in an overnight session it's just the bond price. But when it gaps down, you know that this is now a sell. So this is now a positive correlation, and it should always be very, very simple to follow. So when we see the shape of it, when we see the directionality of it, we can see how much this bond sell really made a lot of sense in the morning session, right? We can see just how clear the bond short trade was against that inflation break-even storyline here, here, and here. Now, as we drop down into this, of course, what we've been hoping to see is we've been hoping to see the inflation break-even diverging against this bottom print. But it's not really diverging just yet, is it? It's not really got into that sort of strong diverging storyline into the bottom edge. Now, there was a little bit of divergence here on that first pin rejection there. Yeah, it's okay. It's tradable, and it certainly made you some money. But obviously, with the inflation break-evens coming back down, and the only real opportunity would have been to maybe buy into this one here. That might have been the best opportunity to buy the reversal on the bond here. And obviously, we're only now a couple of minutes away from, in fact, just under a minute away from the cash open, so that we can actually get into seeing the US inflation break-evens against this and making a read against the US inflation break-evens. So to do that, you're obviously going to go into your tips markets and you're going to get ready for the US open for the tips markets. And this is the 30-year inflation break-evens that's coming onto the screens just now. And you'll get a gap on this, and this is your opening call on the tips. Now, you can obviously do the fives if you're so inclined. You can do fives against TipX, of course. And if I compare this to ZF contract, and we divide that by the TipX, you'll see the TipX is the 1 to 10 year tips. That gives us a good idea about that as a possible trade narrative as well. And that gives you a 5-year break-even in the background as well as your 30-year break-even. So you've now got the two break-evens in the same chart, and obviously you'd like to put both of them into the context of the cash open. And these are now positive correlations. So you're obviously going to be a buyer when one goes up and one goes down, and so on and so on. So that gives us a starting point into the cash open. But into the cash open, let's get a read on our S&P. See how that's starting to set up. So in yesterday's market, it was kind of neutral. The top edge sells were very obvious. The bottom edge divergence at the close was average. The bottom edge divergence this morning seems to be relatively from last night, seems to be relatively bullish going into this. But the open today looks as if it could be a buy trade from lower prices at the moment. That seems to be the value, but obviously it's got short-term bearishness, so we'll watch that to see if it evolves. But at the moment, the value seems to be this, but let's just let this line catch up first. Let's get the data clear, and then we might be able to start looking at this from the point of view of a possible bottom edge buy reversal. Let's see if that's something that might start playing out. Yep, see the price of volatility a little bit more expensive, so I'm not buying it just yet, guys. That's not on my cards at the moment. So the only trade so far has been your short cash open trade. What do you mean a short cash open trade? Well, if you've ever learned about the cash open, what happens is if we take it down to a 5-second chart, which you need to do if you're going to trade the cash open, it's the opening move of the cash open that's important. The opening move. So in other words, as soon as it goes up or down, we want to start getting into the trade. So the first thing, if it sells off, you're in it. If it buys, you're in it. You're always going to be in it. You're always going to be in that cash open. And this is where a lot of money's made or lost in here. So when we're looking at this, what I'm normally looking for is the first rejection for the cash open. The first rejection So when I come into the cash open, you can see the candle before the cash open candle here is a pin candle here. So if the price goes up a little bit and sells off, I'm going to be selling it below that price right there. I'm going to try and capture that sell-off candle. And that's the opening play on the cash open, isn't it? That's what you do at the open. You try and capture the opening drive. And that's that rejection in the background, and then it sells off. If it rejected the downtick and then it bought, you buy it. It's a really easy trade to practice in the early stages, and it gets you kind of active, guys. It gets you kind of active. And you've got to be kind of active. These are all trades that you can have you have to work on to try and perfect. But you, guys, if you perfect the cash open, some of the biggest moves in the history of the US stock market have been at the cash open, the biggest moves. And therefore, if you can perfect the cash open, you can actually be part of some of those biggest moves. But you've got to know what you're doing. You've got to be willing to go in for a scalp, take a deal, and get out. Take a deal and get out. Okay. So we're starting to see a bit of an improvement in the break-evens on the 5s and the 30s. So watch that bond on a downtick, guys. That might be something we could take advantage of. I'm just getting a little bit of pressure on the 30s, but the 5s are certainly improving. And short term, that might just give us a possible buy trade on a downtick on the ZB at the moment. We're looking at a price of about 159 evens. Just to get that extra bit of value, isn't it? Just to get that little bit of extra value. Dollars off the charts for me at the moment. I can't justify a trade. The flatness of the curve at the moment, I'm not seeing anything that's giving me a value trade, so I'm happy to be on the side watching from outside in just now, guys. Nothing of particularly any interest for me just now. Hopefully that ties in with what you guys are seeing.